by the management of the company. Sridhar Patra, who is the Chairman and Managing Director of NALCO, is joining in. Thank you so much, Mr. Patra, for taking the time. Aluminium prices have been very volatile of late, and recently that's on account of the geopolitical issues that the world has been facing. They've cooled off owing to the demand concerns in China, but now going ahead, what is the outlook as far as prices are concerned?
There are two things I will speak. This is a competitive market where the price is determined by demand and supply process. If you see the Q4 of the last financial year, or technically Q1 of the current calendar year 2022, the gap between the global production and consumption was narrowed down. So basically the capacity, what the production facility across the globe is more or less at par with the consumption or demand. So certain abnormal factors which create an apprehension in the mind of the public in general and the traders in general, that what will be the impact of the Ukraine war, what will be the impact if the imposition continues, what will be the impact if the demand increases, economic revives. So those apprehension push the demand sometimes a little bit more, so that which is leading to price fluctuation. But the market analysts, they speak beyond $2,600 to $2,700 per ton of metal. The downstream industry cannot survive. And if the price will be high, it may not be affordable by the aluminum application-oriented industries.
Good morning, Mr. Patra. This is Cheryl also joining in the conversation. And this quarter performance for NALCO was actually aided by high aluminium prices. But if you look at the prices of aluminium, since then it's cooled up nearly 30%. So how could the coming quarter shape up, given that we've seen a drop in the aluminium prices?
Again, I will assure that the coming quarter, despite all crises, we are putting our sincerity efforts to continue the highest level of production. And first time in the history of the company, we have produced last year 460,000 tons of metal. And though it is a regulated production based on the market price, but the present market price does not allow for regulating, we will be producing the maximum. And coal crisis, whatever we are facing, we are making all alternative arrangements. With this price, we can survive and sustain. So we are quite hopeful. So far production is concerned, we'll be doing to the maximum extent of the full production capacity of 460,000 this year.
Mr. Patra, you saw EBITDA margins expand to over 37%. Just wondering whether there have been input cost pressures in the ongoing quarter, and what's the trend with regard to input costs?
Input cost, you see in the market, everybody is facing the inflation. The oil price went up, and basically CP coke, CT pitch, the prices increased manifold, and the fuel price also increased more than 50%. So when basically the fuel oil and the CP coke and CT pitch, these are all dependent upon the fuel market. So the fuel market at present is at the peak, and we are quite hopeful that with this price we can sustain. And the input cost, though it increases, we do not consider this as an impediment, because the prevailing selling price or LME, despite of increased cost, also gives some margin.
Right, Mr. Patra. Talking about margins once again, if you look at the margins in this quarter, it came in at around 37.2%, as Alex had mentioned, and this is versus 33.4% that he saw last year. Do you think that the margins at around 37 levels is sustainable?
Year end will be the better result which we can predict, because market is volatile and it is too impossible to predict a stable percentage at the beginning of the year. We do for 7 months, 8 months, 9 months, we can say major part of the year is over. So the rest part we can take a foresightness. But from the beginning of the year, taking a foresightness it will not demonstrate the correct picture.
Okay, that's a fair point, Mr. Patra. But could you give us a sense of how you see demand in the remainder of the financial year?
I explained you the capacity across the globe, production and demand, it almost matches at par. Though gradually the production capacity is increasing, the demand is also increasing. It differs from country to country, but globe as a whole, if you see, the demand and productions more or less at par. And the minimal difference occurs, sometimes demand exceeds, sometimes production exceeds. So that impact in a perfect competition market is very insignificant.
Mr. Patra, your company, that's NALCO, has been allocated 2 coal mines, that's Utkal D and E. We understand the mining at these mines will start from FY24 onwards. How much decrease in cost of production could we see on back of these mines?
Mines will operate and will get the coal. Whatever the cost of production will be incurring, it will definitely lower than the market price what we are buying from the market. Because in the recent past, you might have seen, due to the restriction imposed on coal supply to the CPP, or rather I will say the direction given to supply coal to the IPP, that has created some imbalances. So the coal prices shoot up through auction, even up to 10,000, 12,000. Depending upon the cost, observability and the affordability, people bid it. But ignoring those things in the long-term perspective, because this cannot be a long-term crisis. So ignoring this long-term perspective, whatever the cost of production will be incurring, that will be much lesser than the price what we will pay to buy from MCL or Coal India subsidiaries. Because I am confident once the production starts, the exact cost can be determined. The DPR cost is only an indicative. So that's what I am telling. Once the production start will be, but we are confident that there will be some delta which will be added to my bottom line.
All right, Mr. Patra, thank you so much for taking the time. Appreciate your spending time with us on ET Now.